Hey guys, good morning, everyone. Presume I'm audible enough. Okay. Uh, I'll just enable the chat. It's just Hi guys. Good morning. Uh, so we have how many people? We have 12 people. One second. Yeah. So there are still people joining in. We'll for some time. Roughly, I think we should be comfortable with 30 people in the. So today we will be starting with the capital budgeting. We'll be starting off with that module, and we would be looking at financial feasibility, financial viability, INPV, IRR determination, and various other facets related. So we will be doing a simple, I would say, we can call it a case, or we can say a small case related to computation of NPV that also we should be able to do, provided we have time. And let's see how much more we can cover related to this. So yeah, we have 16 people. Let's wait for 1 or 2 more minutes and then we'll start. Okay. Give me 1 or 2 more minutes, please. Hi, where did you see this? I'm not an investment advisor. I think you're mistaken. You've read something wrong over there. I am not an investment advisor. Where did you read this, by the way? I think you've read something wrong. I only conduct trainings, nothing else. I have never advised for any investments or anything. Probably either you have read wrong or somebody's misused my profile. There are two ways only this can happen. That's why I'm asking, where do you see where did you see this? Right. So we have 22 people. I think we'll have to start off. These are the many people who are joining. Okay, let's start off. Just give me a moment. I'll share the Excel. One second. This is a very old one, actually. A very, very old one. Something very old. Must have put it, but done nothing with that. So, right. It's a very old one. I've never even done any work related to this. Might have put in, but very old, actually. It's not for investment advisement. That's for consulting projects. That's different, actually. It's different from investment advice. Okay. So now I conduct only training, nothing else. Where were we? So now we are going to look at financial things from capital budgeting and financial feasibility point. Now, before we get into this, there are two concepts we need to understand. For that, we need to look at the life cycle of businesses. So businesses are actually built for two things. One of them is, first case, the businesses are built to be sold later on. So you are building something, you're building a venture or you're building a project, maybe to sell it off later on. Second is build to grow. So you are setting up a venture and you are looking at growing it. This is the first, these are the two classifications. Now, something which is built to grow is mainly capex oriented. You're trying to do a capital expenditure, you're trying to expand. So those kind of financial projects, when we are looking at, we have two decisions to make. Firstly, is it financially feasible? Now, when I say feasibility, what I'm looking at is it going to happen? Right? Second aspect is financial viability. When I say financial viability, I'm looking at, is it profitable? Is it something that provides me any kind of profit? So if I invest my funds into this kind of project revenue, am I going to gain profit out of it? As a business, I'm always looking at two things. One is financial feasibility, and the second thing is financial viability. So viability is something which looks at profitability of the venture. Now, there are two techniques which are being utilized for financial viability. One is NPV and the other is IRR. So we are looking at financial feasibility, one concept, financial viability. Two techniques are used for financial viability, NPV and IRR. Okay. NPV, IRR are basically two techniques for capital budgeting. Now let's understand each of them. Firstly, what exactly is NPV? So this is the difference between the present value of cash inflows and present value of cash outflows over a period of time. So when I took your Excel sessions, we looked at the computation of NPV. What we looked at there was that there is somebody has this X amount of money. Either they invest in a bank account or earn certain percentage of interest, or if they forego that interest, so that becomes their opportunity cost, and that money is invested, let's say, in a fund, in a friend's project or something. So there are certain cash flows and investment, and those cash flows are discounted based on the opportunity cost to the present value. The sum of those discounted cash flows and the investments gives us the net present value. So net present value is the difference between the present value of cash inflows and the present value of cash outflows over a period of time. NPV is a tool which is being utilized in capital budgeting and investment planning to analyze the profitability of an investment or project. So NPV is the result of calculations which find the current value of a future stream of payments. These are future expected stream in most of the cases, based on a proper discount rate. Discounting rate, the example that I gave you was the opportunity cost. So projects which have got a positive NPV are worth undertaking, while those with a negative NPV are not. Projects which have got a positive NPV, they are something which are worth to be taken up, while those which are of a negative NPV are something not to be taken up. We will look at the calculations also. I will give you examples for that. Right now, we are understanding only the concept. So let's say you have a cash flow. If you have to discount it, so cash flow divided by 1 plus cost of capital or opportunity cost to the power timeline, number of time periods, whether it's for the third year, fourth year. And based on these discounted cash flows, subtract the initial investment, we get the NPV. This is what we did also in that computation, if you guys remember. Okay. So NPV is basically the accounting for the time value of money, which can be used to compare the rate of return of different projects or compare a projected rate of return with the rate required to approve an investment. So basically what we are trying to understand is if our NPV is a positive number, then it gives us a sense that this is an investment worth considering in. Because we are considering in the concept of time value of money. In simple words, if I have to explain to you what is time value of money, what that means is that money, what is worth today, is going to be less what it is going to be worth tomorrow. That is why if I'm investing somewhere, my money, I need a certain return. I need to fetch a certain return based on my investment so as to account for this time value of money concept. Okay. So this time value of money concept is represented in the NPV calculation by the discount rate or the discounting factor, the opportunity cost, the cost of capital into consideration. Okay. So negative NPV shows that the expected return is going to fall short of it. So the project is not going to be viable or not going to create value for me. So it makes sense to consider a project which is giving us positive NPV or negative NPV is something which has to be discouraged or not taken into consideration. So this NPV methodology is often referred to as DCF analysis, discounted cash flow, which we looked at a sample last Sunday, if I remember. Okay. So this is for considering NPV of a future cash flows based on the current pricing that is. Okay. Let's now look at some example to understand how we compute. For a lot of theory we have had. So let's say I have a business wherein I have raised 200 crores, okay, at a loan of 8%. 8% is my cost of funds. So 200 crores, which is raised at a loan of 8%. And I'll also list out my cash flows that are there. So this is the year, and these are the cash flows. Start with 0, 1. Let's say I have in total 6 years I'll take in, suppose. Okay. And cash flow, suppose minus 200, negative since it's an investment. When I'm making an investment, money is going out of my business account. Okay. And let's say this is 80, 95, 110, 120, then 135, 15. So these are my cash flows. These are my estimated cash flows. In case you guys are not clear with any of the concept, please feel free to pitch it. Estimated cash flows. and this is my investment. Now, we will look at the elaborated method of computation first. So what we'll do is, we'll be discounting this based on 8% as the rate. Okay. So if I discount this, this becomes value divided by 1 plus 8% to the par year. Since it is 0, it's giving me the same value. If I just drag it down, so this is giving me the all the values. So if I look at this, this will be 80 divided by 1 plus 8% to the par 1. Okay. Now, if I sum this, what I'm getting is 317. So this is a positive number NPV that I'm getting. So this is a project worth looking at. Okay. Now, if suppose I do this for use the formula directly, what I get is 8% is my rate, all the cash flows, and the out. But I'm getting a different number. Can someone please tell me why I'm getting a different number for NPV when I use a formula directly? What is the adjustment that I need to make over here to get the same number? So this is the correct number. What mistake have I done? 0th here needs to be added separately. Correct. What mistake I've done over here is I only need to take into account the estimated cash flows, not the investment in the formula. And I need to consider the investment separately. Now I'm getting the right answer. Understood this part? What mistake I did? I purposely did the mistake just to explain it to you guys. Whenever you compute NPV using the formula, always keep the investment outside, isn't it? So what this is the way we compute the NPV. This is the DCF methodology that we have used. Okay. So this is basically this is actually the DCF methodology in detail. If somebody has a doubt, tell me, please. Yeah, you wanted to ask some doubt, Mamta, I guess. Show again the formula. Sure. So I'm writing the formula again. 8% is my cost of loan or cost opportunity cost. Considering the cash flows plus the investment. So convert this to number. This is what our NPV. Which one are you not present? The elaborate computation. Okay. So how we are doing this is equal to cash flow divided by 1 plus 8%, 1 plus R or 8% the cost of loan to the power year that cash flow is. Just drag this down, you will get the output. Now it's fine. Why are we taking 1 plus? That's because we have to discount. Na? That's what we discussed in DCF. So cash flow divided by 1 plus R to the power n. Basically, I'll explain it to you. Suppose if you have learned that amount and principal. So let's say you have got X amount, you are compounding this for n number of years by R%. So it will be, amount will be A equal to principal multiplied with 1 plus rate of interest to the power number of years. Discounting is opposite of compounding. This is what we have done over here. So I think I explained that last Sunday, that there's something known as compounding. Opposite of compounding is discounting. Discounting is what we do. I hope this is clear with everyone. Whosoever is not clear with the computation, they can ask how exactly this is. NPV is a part of DCF methodology. What we are doing is discounting of cash flows only to determine NPV. NPV is a capital budgeting method. Capital budgeting is DCF only, discounting of cash flows. So if you look at this over here, what we have done here is discounted the cash flows only. So suppose you have got A amount of money, you compound it for n number of years at R rate of interest. So your amount at the end of nth year will be principal, initial principal multiplied with 1 plus rate of interest to the power n. This is compounding. Opposite of compounding is discounting. Discounting would be A divided by 1 plus R to the power n. This is what we are doing over here. This is discounting of cash flows only. Okay. Now everyone is clear? Questions, anyone, guys, in this part? Because this is the basic foundation, and after that we are going to talk about equity is different. In equity, you don't compute NPV. Why would you compute NPV in equity? You have got a lot other things to look at. Return, this return, you say, ratios are there, no? In equity investments. So concept of DCF is much more prevalent in case of fixed income rather than equity. Because in fixed income instrument, you got a fixed amount being paid after every time interval. And at the end, you get the principal also. So you discount that to determine the issue price of the bond. There DCF is used. So I hope you guys understand what's a bond, fixed income, and what is the issue price of the bond. So I don't know whether you guys are aware about bond pricing, but when you do bond pricing, you need to determine the issue price of the bond. And from the issue price, the issue price is dependent upon whether the bond is issued at premium, at par, or discount. So there, this concept of DCF comes into picture. Rather, this DCF comes into picture, not in equity investments. Okay. Now, where was I? So this is the basic understanding we have with respect to NPV. So if NPV is positive, then the project is viable. But if NPV is negative, then the project may be feasible, but not viable. Understood the difference? It's not viable. That means it is not profitable. The feasibility part might be there, but viability will not be there. But definitely when it is not viable, why would we put in our money? We only put in our money in those projects which are viable for us. If the projects are not viable for us, as an investor, I would hesitate to put in my money over there. Okay. So there is another metric that comes into picture, which is based on return perspective. So we look at internal rate of return, or IRR. IRR is also referred to as internal rate of return. Okay. So internal rate of return is another metric which is used in financial analysis to estimate the profitability of investments. So internal rate of return is a discount rate that makes the NPV of all cash flows equal to 0 in a DCF analysis. So the discount rate for which the NPV of all cash flows becomes 0 in a DCF analysis is your IRR. So IRR relies on the same formula as NPV, right? So in case of IRR, this is not the actual dollar value, we get a return, annual return, such that our NPV becomes 0. So higher an internal rate of return, the more desirable an investment is. Okay. So it is useful, IRR, for ranking multiple prospective investments or projects if you want. This is where IRR can be used when you want to compare multiple projects, right? Generally, investment which has got higher IRR is probably considered the best. So IRR, if you have to determine, it's the discount rate which is making the NPV of all cash flows equal to zero in a DCF analysis. This is what IRR is. Theoretically, is it clear? Now let's look at the computation part. How are we computing? Very simple. IRR, internal rate of return. Here we need to take in all the cash flows, including the investment. What we get is the percentage. This is a very good percentage. In fact, even NPV value was also very good. So that if you are comparing cross with projects, so higher the IRR, better is the investment outlay. Okay. So for computation purpose, if you have to go to elaborate, discount rate for which the NPV of the project becomes zero, that is your internal rate of return. So you can set your net present value to zero and solve for the discount rate, which will be the IRR. Okay. So you can actually do that using, I mean, if you want to do it through trial and error, or you can compute it using this Excel computation also. All right, but the understanding remains the same only. Now, there are various other methods, XIRR and all that we will be looking up later on. So, but the goal of IRR, ultimate goal of IRR is to determine the rate of discount, which is making the present value of all annual cash inflows equal to the initial net cash outlay. So cash for the inflows that are coming in from the cash flows and the investment for the present value of all of them when becomes zero, we get the rate of discount rate, which is our IRR. Okay. So IRR is actually considered very helpful for analyzing the potential return or the potential return on an investment that we are making in a new project. Therein, IRR comes in very handy. So it's very helpful in terms of capital budgeting or capital planning. So if you want to estimate the profitability in cases of, let's say, you are expanding your business operations or you are putting in money into a newer project, therein IRR comes in very, very handy and very helpful. So a lot of financial decisions can be undertaken for even looking at IRR. Even in case of, that's something that you will study later on, LBO, for example, leverage buyout, M&A based on leveraging. There also IRR is considered a very important parameter for decision. Because ultimately, wherever you are putting in money, you want to fetch higher returns or better returns. So there, IRR as a metric makes much more sense. So this is just a brief overview of what exactly an IRR is. Any questions, any doubts, guys, in this computation? Anything not clear? This is the internal yield or internal rate of return. Any questions, guys? Move on then. Just 1 second. Just a second. 1 second. Just a second. Yeah, I'll give you a lot of examples. Just give me 1 minute. I need to send some link. 1 second. 1 second, please. Issues. Okay. Where were we? Somebody wanted an example. Example for computation of NPV or IRR or both? I mean, example in the sense, example from utility perspective or example from computational perspective you're looking. If you could help me out to understand, because example would be, one example is something that I've given. So what kind of example are you looking at? If you could help me out. I think you are the one. Because computational wise, this is what an example would be. Are you looking for the application, so real life, where exactly we could apply this? Or, I mean, if you could help me decide it better. Because another example would be similar lines only in terms of what I would do is I would take a project, take in the cash flows, and same way determine the NPV and IRR. So, yeah. That's what let me understand. Usage in real life. Okay. So basically, when IRR is also, you can use IRR even in your personal things also, personal decision making, wherein there also IRR can be used. So let's say if you are buying life insurance policies, okay, and the life insurance policies that you are buying, when you evaluate them, you find that similar premium, the one which gives a higher IRR, higher internal rate of return will be much more desirable. Okay, so even in your real life things also, you can actually use this IRR computation. While IRR is definitely useful for capital planning or capital budgeting. So let's say if you want to expand, you have a business and you want to get into a new line of business. Okay. So one scenario would be that you are looking at the profitability of the new operation chain that you want to set up, or you want to expand the existing operations. So based on IRR, you would be deciding whether you want to open a new outlet or you want to renovate the existing outlet, whichever is giving a higher internal rate of return. Based on that, you could decide. So these are one or two real life applications. So if you have to answer, I mean, in terms of real life applications, usage of in real life, you may answer like that. Hope Pranjal and Mamta is fine to answer in terms of what is the usage in real life scenarios. Now, computational wise, if you want to understand, I will give another example. So let me take another project and let's say I have a, one second. I'll take two projects. One is project A with the, let's say, initial investment I take in is 5,000 crore, let's say. And first year I have, suppose 1,700 is what the cash flow is. Second year I've got 1,900, suppose. And third year I have 1,600. Then fourth year I have 1,500. Fifth year I have 700. So this is one project A that is with me. Let me consider another project. So there's a company which has to decide in which of the two projects they should invest. And cost of capital is 10%. So over here. Okay. So cost of capital is given to be 10%, and project A initial investment and cash flows are there. And let's say I take another project B. In 5 years I'll take in. And let me consider the cash flows investment to be 2,000. and this to be 400, 700, suppose, 500, 400, and let's say 300. So IRR, if I have to determine for project A, these are the values. Simple. 17% is what I'm getting here. And IRR for project B is 5% is what this is giving. So obviously, if I have to do a simple, computation or simple comparison, so considering that the cost of capital is 10%, definitely the management should proceed with project A investment rather than project. Because project B is even less than the cost of capital, the opportunity cost. So it doesn't make sense to invest. So this is one way of comparing two projects only on basis of IRR. Although there are a lot of things, other things we need to consider later on, because I'm not taught you those concepts. So this is a simple way of financial computation in Excel that you could do. And real life scenarios, one or two examples also of IRR I've given you. But if you have any doubts, you may ask me. This is the basic, very basic of IRR if you want to understand. Right. So internal rate of return acts as a very good guidance whether we should be proceeding with the project or investment or not. Right. So if the IRR, let's say on a project or investment, is greater than the minimum required rate of return or your cost of capital, then the project or investment can be pursued. This is the way you can invest in a particular project on the basis of IRR, and this is the basics of capital budgeting that comes into picture. Is this fine, or any questions, anyone, guys? Any questions, any doubts here? Based on the concept that we have discussed? Any doubts, any questions? Because this is important. If you have questions, you can ask me. Because from now on, we will be building concepts on this. A lot of things we are going to discuss, like EAA method and replacement method, all things related to that will come up later on. So better to discuss it right now if you have any questions. Negative. How would that be? Business sense, it won't make. Business sense, it won't make, because that means you're not getting a return. So you're not fetching a return. So business wise, that's not making a sense per se. Okay. Show the IRR A and IRR B formula once again. This is IRR A formula. This is IRR B formula. Okay. So comparison of NPV and IRR and which one is better, we will do after 1 hour or something, because I have to discuss that, but not right now. So that will come later on. Like which one is better out of NPV and IRR, that I'll do. Correct. So what that means is that, let's say, suppose if I compute NPV for this, let's say, okay. How do I compute NPV? 10% is my rate, my cash flows, plus investment. Convert this to number. Now my current NPV is coming to be 776.97. Okay. But discount rate I took it as 10%. Now this should be 0 when I take it as 17%. Let's see whether I am correct or not. Should be. Otherwise our computation is not right. It's not exactly 17%, but should be close to 0. As per 0. Why? Minus 40. So that means this is not exactly 17%. 16.6. Suppose if I take 16.6, 16.6 and 17 are very different. That's why we are getting this 40 number. And even after that, it's slight number. So that means I have to take another decimal over here. 16.61. Let's say with what we get now. Somewhat very close to zero. So that is what I meant when I said that when NPV is zero, we get IRR as the discount. Now is it fine? Anybody clear, Mamta? You asked me this question. Okay. Any other question, guys, related to this? So this is what I meant when I said that when NPV is zero, the discount rate that we get is the IRR. Any other doubts, guys? Any other questions before we move ahead? Hopefully this is clear. Let's move ahead. Now we will see that like someone amongst us asked me like which is a better parameter? Well, what should we look at, NPV or IRR in cases there is a conflict? So NPV gives us the projected future cash flows which are discounted at the predefined rates. While in case of IRR, cash flow are discounted using hit and trial method or trial and error method, making NPV zero. So discount rate is not predetermined. Like I showed you right now, when I use 17% as the discount rate, I got some other value. When I use 16.6, I got some other value. So what I'm doing is trial and error method in determining the discount rate. Okay. So NPV takes into account cost of capital or market rate of interest. This is correct. We are looking at cost of capital only. IRR doesn't look at the market rate of interest or cost of capital, but the maximum rate of interest that the earnings are made from the investment amount. So IRR is looking at the maximum rate of interest only. Sorry, I'm not able to get your question. Are we solve any company financial services in the case? What does that mean? I mean, can you please reword your question? It's not clear. You're asking about, are we going to do any case study? So probably we are going to look at one problem statement, company financial statement audit. Audit is not part of your learning. Audit is not we are looking at. So what you're asking is, so probably I think I mentioned this, that once we have learned FCFE and FCFF, there is one sample. I mean, we are going to look at sample data and develop the balance sheet, income statement, and cash flow statement. Along with that, looking at from that we determine the FCFE. That sample case we will do, but we are going to take dummy data to do that. That we are going to do. That I think I mentioned it beforehand also. If this is what you are referring to. But we have not learned FCFF and FCFE. We have to consider the theoretical part first. Okay. So I was actually telling about the comparison of NPV and IRR, which I'll repeat again. So NPV looks at the projected cash flows, projected future cash flows, which are discounted at the predefined rates. In case of IRR, cash flows are discounted using trial and error method, making the net present value zero. So discount rate is not predetermined. NPV takes into account cost of capital or market rate of interest. IRR doesn't look at the current rate of interest in the market, but at the maximum rate of interest such that the earnings are going to be made from the investment. That's what we are looking at. We are making the NPV zero and getting the maximum rate of interest. In case of NPV, intermediate or in between cash flows are being reinvested at the cutoff rate. While in case of IRR, intermediate cash flows are being reinvested at the IRR, current IRR. This is the difference. Because if you look at IRR, it is taking in the internal rate of return for the intermediate cash flows. Intermediate is coming in between. In case of NPV, it is looking at the discount rate. Now, when there is a conflict of interest between NPV and IRR, in case of mutually exclusive projects, we would be selecting a project with higher NPV as compared to IRR. Because higher NPV is something which leads to an incremental value in the shareholders' wealth. So NPV is also a determinant which project is going to add to a higher value with respect to the shareholders. Because a business that is being driven, it is ultimately driven to provide profits to shareholders. If as a business, I am not providing profits to the shareholders, people will stop investing in my business, in my firm. So definitely I would be selecting those projects which are incrementing or contributing positively to the shareholders' wealth. So if I have to look at this way, NPV is a better methodology for determining which project is better as compared to IRR in case of a conflict between the two values. Now, is it fine? I hope it answers the question. Somebody asked me that what happens in case of both. So NPV will be given preference as compared to IRR. Understood the difference, guys, between the two? Firstly, understood the difference, understood the logic why NPV prevails over IRR. If you have any questions, you may ask me. Otherwise, we will take up a computation. Because the next concept we are looking at is XIRR. In case this concept is clear, we will move to the next concept. Are you having any questions, guys? Any doubts in this part? Is anyone having any questions in this part, or are we good to move ahead? We are good to move ahead, I guess. Here's a question. Now we are going to look at the concept of XIRR. Let's see what it is. The concept of XIRR becomes important or holds relevance when our cash flows are not happening on the same date of every year. This is a very probable thing, right? A lot of cash flows, they are happening on different dates. So when our cash flows are not happening on the same dates every year, we need to look, if we want to determine the internal rate of return, we need to look at the computation with respect to XIRR. So we will take an example of a company or a business which is of a cotton producing business, let's say. Okay. We consider a cotton producing firm. Okay. So these are my cash flows. So let's say in 2018, I have purchased cotton farm and if I put in the exact date, I do it on the 1st of January of okay. Since I have purchased this is an investment, so it's a negative, will come in as a negative value. Money is going out of my account. So let's say this is in crores. Okay. And suppose in 2020, I sell off the cotton farm. Say I'm doing this on 31st 12 2020, last day 31st December. And suppose I have disposed of in 550 crores. Okay. So I'll just mark this in a different color. So basically, I have purchased this on 1st of January 2018 for 500 crores. And I have disposed of this cotton farm on 31st December 2020 for 550. Now, if I have to look at intermediate cash flows for the 2 years, suppose I have March 2018, let's say. I have my sales earnings. I put in 31/03/2018. Suppose it is 25. So since it's a sales earnings, it has to be positive. And let's say in March 18, I have my operational expenditure and OPEX to be 2018, which is -5. Since it's an expenditure, so it's going to be a negative outlay. I can actually expand this for all the values. I'll just take in the dummy value to waste. So I'll just go here. I'll do is convert into a short date, or I'll just format this. This OPEX is operational expenditure. I'll just write over here. OPEX is operational expenditure. One second. Yeah. So basically, what I've got here is these are my intermediate cash flows. Okay. It's something that happens every quarter, sales and OPEX, operational expenditure, and these are something the final cash flows. Now, I can't, if I have to determine the internal rate of return, these are my expected cash flows. I cannot use IRR because they have happened on a different day. So what I'll use is the concept of XIRR. So Excel-wise computation of XIRR is not a very tough thing. Okay, it's something that would involve just the simple computation. So if I write XIRR, my values are, these are all my cash flows. Okay. Right. If I convert this to percentage, adding the decimals. So this is giving me a very good IRR, internal rate of return, considering the dates too, as a project. If these are all my cash flows. Now, I will add in two more parameters. I want to do a sensitivity analysis. So if you remember from the Excel sessions, you guys learned how to do a sensitivity analysis. This is, I'll write change in purchase value. So let me add in a percentage. Suppose right now I put in 0%. Let me add this over here, -500 multiplied with 1 plus this 0%. Same way. So selling off the business is also referred to as terminal value. Introducing you the concept. Okay. So if I write over here, engine terminal value, and okay. So if I have to do a sensitivity analysis, then let me look at the change in terminal value. So I write -%, -4%. Same way. -10%, suppose, minus 8%. Let me 6, 8, and so let's say if I've taken it like this, so I'll just select this table. So one more thing before I do that. Merge and center wrap text. So this is my terminal value change. This is my purchase value change. One second. I go to data, what if analysis, data table. So my row input cell is the purchase value change, this one. And my column input cell is the terminal value change. Okay. Converting this to percentage. Okay. I'll do a conditional formatting. I want to highlight cell. So I want to increase the XIRR from this part. I'll write equal to this value. So what I find is from this that obviously when I reduce the purchase value, it's good for the business. My operational cost decreases. And I can have, any of the terminal values as long as my change in purchase value is not 0 or it's less than 0. So this is how we can undertake a sensitivity analysis for this and how we can determine the XIRR. So two concepts to look at: the concept of XIRR, what do we mean by terminal value? And of course, sensitivity analysis is something which we will be doing a lot. This is the concept of XIRR. Any questions, guys? Anything you want to ask? Any doubts, anyone? Terminal value is basically the sell-off value of the business. So after the useful term of the business, when you dispose of the asset or when you dispose of the business, that value is the terminal value. XIRR formula. So XIRR formula is this one. We take in all the cash flows along the investment and the timeline. That is how you determine your XIRR. Sensitivity analysis again. So basically what I've done over here is I have taken, these are the changes I want to enact in the purchase change value. This is the value. These are the changes in the terminal value. This is the original value I have linked it. Select this table. Go to data, data table. Row input cell is my change in purchase value. Column input cell change in terminal value. Click on OK. Convert this to percentage. The ones which are higher than the 69.5 is the ones of utility tools. That is what I've done over. Okay, this is dummy data. It's coming like that. So in real life data, the analysis depends on data. It differs how our data is. You can take it different also. I've taken this as dummy values. You can take a different value. So I have linked it with this value. So let's say if I take this 1%, my IRR changes. So based on that, the selection also should change accordingly. Because if I make this 4%, so you see, This values have changed. Did I link it? Oh, sorry. One mistake I made. I didn't link it. Yeah. Now you see this selection changes. So based on this change, my values are changed. I just took it 0% just for dummy thing. You can change the values also. Since you already purchase it. So basically, what changes is that over sometimes what happens, we are making regular purchases. That ways it might change. That's why I've changed. And this is also the change at the initial stage I'm talking about. So this is the change in the initial stage I'm talking about. So you might have changes in the initial stage now. At 2018. Suppose instead of when you are purchasing at 500, you purchased at 505. Then, so there are two things that would come into picture. In this scenario, that is not applicable. We are not doing it in midway because my intermediate cash flows are not such. But in certain cases, it might be real life scenarios that you have intermediate scenario. That's the first thing. Second thing is this is the initial price. So in 2018, instead of 500, if I buy at 505, then what? Okay. Was just to tell you what the meaning is. That is the only reason. Because I wanted to link this with this data table. That's why I've taken it separately. If you want to compute it over here, you don't need to take it separately. You're only just creating this. Understood, Mayur, why, how could a change in purchase value could be there? So one rationale that is prevalent in this case is initially at 2018, if you are, let's say, purchasing it for 505, that ways. I think I've answered all the questions. Anything I missed out? Any questions you have, guys, other than this? Can you again show how to put the values in the sensitivity analysis table? Okay, just give me 1 minute. I'm showing you. Okay. Go to data table, row input. Inputting that I'm doing in the rows is of purchase value change. Column input I'm doing is the terminal value change. Click on OK. एक second. Achha, I'm not selected. Sorry. Did not select. So row input table, change in purchase value. Column input table, change in terminal value. Click on OK. This you can get. And after that, home, you can put in a conditional formatting. I want to change the color actually. Instead of this color, say I want to put in a yellow. So values पे चलो. Edit. One second. Fill I'll change. Suppose if I want this one. Yeah. Not. Okay. So everybody understood this? Any questions, guys? Anything not clear? Anyone? Still no? So this is the concept of XIRR, concept of terminal value, and how do we do sensitivity analysis. These are the three things we have discussed. Okay. Now, let's take a simple, you can say a sample case, or let's take a problem statement and see how we determine the NPV over there. Okay. So consider, let's say, there is a XYZ company, and it's a capital goods firm. Looking to install huge or large, let's say, you're looking to install a large rubber processing machine to generate rubber on a large scale. Generate rubber on a large scale. The small premise I've taken. Now, consider the cost of equipment to be 3,000. Lifespan of equipment to be 5 years. And cost of equipment at expiration to be 15,000. This is also the ending book value. Two people have raised the hand. What's the issue? Please write in the chat box if you have a query. What happened? I was just writing the premise. Anybody has a question? Two people have raised their hands. Any question you have, guys? Write in the chat box, please. Okay. Nobody has a question. So we have a XYZ capital goods company looking to install a large rubber processing machine to generate rubber on a large scale. So cost of equipment is 50,000, lifespan of equipment 5 years, cost of equipment at expiration, ending book value is 15,000. Now, we have what we are doing is, on this we are assuming straight line depreciation. So we are assuming straight line depreciation or linear depreciation. So linear value of degradation in the value of the fixed asset over a period of time. Now, I'll leave one line. I'll write fixed cost of the project is 800. Assuming all this is in crores, okay? And so starting from the first year of generating a revenue, so every year 5,000 ton is rubber produced. So what I'll write is starting from first year generating revenue, 5,000 ton of rubber is produced every year. Okay. And selling price of 1 ton of rubber. Selling price of 1 ton of rubber in first year is, let's say, considered to be 4, and selling price increases by 15% every year. selling price increases by 15% every year. All right. And cost of each ton of production is, let's say, 1.5. So variable cost is what we're looking at. And salvage value of the machine, the end of the term. So salvage value is basically the market value. Book value is also given, market value is also given, which is 20. Tax rate given to be 20%. And required return that we require from this investment is 8%. So this is the premise that I'm given first of all. So cost of equipment given to be 50,000. Lifespan of equipment 5 years. Cost of equipment at expiration, the ending book value. So this is the book value, not the market value, notional value. 15,000 straight line depreciation is there. So linear depreciation is always on the notional value. Fixed cost of projects 800, and starting from first year 5,000 ton of rubber is produced every year. Selling price of 1 ton of rubber in first year is 4. Selling prices increases by 15% every year. The cost of each ton of production 1.5. Salvage value of the machine at the end of term is 20,000. Tax rate is 20%. Tax rate is given to be 20% and required return is 8%. So this is the basic premise we have over here. Okay. Now, we have the cost of equipment to be 50,000, lifespan to be 5 years, cost of equipment at expiration, book value to be given. Now let's determine the depreciation every year. So depreciation, since we have only the linear straight line depreciation, this is only on the book value. So depreciation every year would be equal to 50,000 minus 15,000. Since this is linear straight line depreciation divided by 5, because lifespan of equipment is 5 years. So this is the depreciation every year. Mark it in a different color so that how it is computed. Depreciation every year is 7,000. Everyone is fine with the computation of depreciation. Any questions in this part? Nobody has a question in the computation of depreciation. Please redo. Which part you want me to redo? Only the computation of depreciation. Okay. So basically, depreciation is the degradation in the value of the fixed asset over a period of time. This is a fixed asset, and we are considering in straight line depreciation. Straight line is linear depreciation. So linear depreciation is on the book value. We have the initial cost. We have the cost at expiration. So 50,000 minus 15,000 divided by the 5 years is going to give me this, which can also determine by SLN actually. My cost is this much. Since it's a linear, I'm taking in the salvage. I mean, I'm taking cost of equipment is the book value only, and life is 5 years. Same value I'm getting here, same result. This is what I've computed also. So you can use the SLN method also, or you can use it like this also. Now, is it fine how we computed depreciation? Anybody? Okay, it is. Now, moving ahead, we have the fixed cost as 800 that is given to us. Okay. And unit per year in ton after 1 year, 5,000. Selling price per ton, 4. Growth in the selling price per ton 15%, cost per ton 1.5, salvage value or market value 20,000, tax rate 30%, required return 8%. Let's develop a cash flow table for all this. So let's do that. Sorry. So consider 0, this is what we have. Okay, it's given to us. So cost of equipment and sales I need to compute, but for sales I need the information. I have the selling price per ton. I think it's given to be 4 over here. Yeah, selling price for the first year is 4. I will write selling price per ton. First year is 4. And this is incrementing by 15% every year. This will be 4 multiplied with 1 plus 15%. Just drag it across. 15%. So this is what I get for the 5 years. My selling price per ton. I'll also need the units for computing the sales. Units, I think, are given to be 5,000 ton every year. So from first year starting, 5,000 every year. Now I can compute my sales, which is selling price per ton multiplied with 5. Fine, guys. Is this part clear to? Is this part fine with everyone? How we have got the sales? Very easy. Selling price per ton, units, take the product, we get the sales. We have the cost of equipment. It's negative because it's a cost. Money is going out of my account. Sales is positive. Money will come into my account. Hope this is clear. Then we have the fixed cost. 1 second, please. Selling price per ton formula. So it was given that it is 4 after first year. After that, increase it by 15% every year. Okay. Just increase this by 15% every year. We will get the selling price per. Okay. Now, fixed cost, I think, is given to be 800. Yeah. This is given to be 800 across. What I'll do is, fixed cost every year is given to be 800. And, oh no, fixed cost here is given to be 800. So let me put in 800 over here. Anyway, variable cost, if I have to determine, I have for the variable cost, 1.5 is the cost of each ton. Okay. And it will be 1.5 multiplied with the units. So variable cost is 1.5 multiplied with the unit. Just variable cost. Now, depreciation we have computed already. So this will be 7,000. value actually can be like this and just drag it. Okay. So we get the depreciation. Then what I need to determine is PBT, profit before tax. Profit before tax would be sales minus fixed cost minus depreciation minus variable cost. So this would be sales minus fixed cost minus variable cost minus depreciation. Just drag this across, I get the profit before tax. Then my tax is given to be 20%. So I'll write 0.2%. Tax is only done, undertaken when your PBT is positive. In case you have a negative, that means you are a loss. You have a loss. You don't have to pay tax in these kind of normal computation. Otherwise, in case it's mentioned anything else, that's a different. This is the tax I have. I think it's missing in this. Tax 20%, 20%. Not 20, only 30, only in businesses. So if I take this as 0.3, yeah. Now we can determine our PAT. PBT minus tax. And now I want to determine my operating cash flow. Operational cash flow. So depreciation is not an operating cash flow. So in order to do that, what we need to do is we need to add depreciation to PAT since it's a non-cash expense, not an operating cash flow. So we have already deducted it. So add this to depreciation. We get this is operating cash flow. This is how we determine normal operating cash flows. Since depreciation is a non-cash expense and we deduct it as part of the income statement outlay, we need to add back to get the operating cash flow, as depreciation is not an operating cash flow. Now, we will also need to look at is the salvage cash flow. This is important, this salvage cash flow actually. You have to look that into depth. So basically, salvage cash flow, when we are looking to compute, we need to take into account the salvage value. Now, there is a difference between the salvage value and market value per se. Okay. So that differentiation of tax is something we need to deduct in terms of the cash flow that we have as part of salvage cash. So the difference between the salvage value and the ending back book value, 20,000 minus 15,000, that tax is something we need to deduct from the salvage cash flow to get the right salvage cash. What that means is equal to, this is the salvage cash flow, is this the market value of this value machine at the end of the term. This is the cash flow that we have. I need to deduct the differentiation between 20,000 minus 15,000. Multiply this with the 30% tax. Get this as the salvage cash. Because that differentiation, that tax, we have not accounted in the operating cash flow. That's why. Further, our free cash flow would be equal to this part. Drag it across. Here, it will be sum of these. And my NPV, I can determine from through this, which is equal to NPV 8% is the return I'm looking at. This is given in the premise. These are the net free cash flows that I have as a business. Okay. This is giving me a very high positive number. It seems a good probable investment to take. Salvage cash flow. See, basically, there is a market value, salvage value that comes. So for that salvage value, right? So there is a book value, there is a salvage value. Salvage value is something that comes into picture because of the market, when they're considering the market value of the goods in concept. So there will be a cash flow for the salvage value, which is what, 20,000. From this 20,000, we have to deduct a tax because in this computation, we have not considered the differentiation for this. We have only considered 15,000 while taking into depreciation. We have not considered this 20,000. So there's a difference of 5,000 we have not taken. So we need to deduct the tax on 5,000, which is what I've done over here. So 20,000 minus 15,000, 5,000. 5,000 multiplied by 30%, that tax I have deducted from the salvage value. This gives me the salvage cash. This is what I explained. This is a, you can say a case, you can say a mini case actually, not a very big case, but this is a problem statement, understanding of the concept of how do we determine NPV, how we are using these free cash flows to determine the NPV and doing a capital budgeting decision. So we have looked at the concept of depreciation, salvage value, salvage cash flow, operating cash flow determination, free cash flow determination, and determination of NPV on this. Okay. Operating cash flow is that you got the PAT, profit after tax. So when we have determined the profit after tax, we have considered the deduction for depreciation. I'll go to 18. So basically, depreciation is a non-cash expense. So we want, it's not an operating cash flow. So when we have to determine the operating cash flow, we have to add depreciation back to the PAT to get the operating cash flow. This is what I've done. Now somebody is saying, please go to I-18. Okay, now I am on to I-18. There's a mistake I've done. Sorry. Thanks for pointing out. My apologies. Now this is correct. I'm sorry. I've done the mistake. Changed this. Actually, in flow, sometimes I've changed it. So this is the right. Now it's fine. And everyone is okay with the computation. I've explained the terms. I have explained the logic. I've explained the methodology. Everything I've explained. So if you are not clear with any of the concepts, please don't hesitate to ask questions. Please feel free. Okay, I'll try my best to answer as much as possible. Right? Yeah. Any questions, guys? Yeah. In this. Salvage value you want. Sure, I'll explain. So there is a salvage cash flow. Salvage cash flow you wanted me to explain. No? Salvage cash flows. Salvage cash flow. That's not salvage value. That's salvage cash flow. So basically, I have the salvage value given to me. Now on to the salvage value. Salvage value, if I want to consider the cash flow, I have to consider the extra tax that is applicable onto the differentiation between the ending book value and salvage value, because in my computation of the depreciation I've taken in, I have not considered that, because that is a straight line, a linear depreciation only on the ending book value. So for that, what I need to do is on this 20,000, I will deduct the taxation onto the difference between the salvage value and the ending book value. This is what I have done to determine the salvage cash. So NPV is determined on the full cash flows. So that's why we have considered the salvage cash. Any other question, guys? I hope this is helping you to build up your concepts, because you guys have been asking about case studies and applications. So this is purely from application point of view, and this is just to help you build your concepts, purely to understand how we are doing the computational part, and this is where our Excel usage comes into picture. So if you guys have any questions, you can ask me, or I'll move ahead to the next concept if you're fine with it. I guess people are fine with this. People are okay with this. Good, we can move on. Thank you. Now we are going to, so MIRR is something I'm not discussing right now. We don't have that much time. MIRR is something I will discuss next Saturday. Okay. Right now, the time that I have, there was a voice problem in salvage cash. Okay, I'll repeat salvage cash. Okay. No problem. I'm repeating salvage cash. Not an issue at all. Salvage cash flow is something that is being computed based on the salvage value of the asset, fixed asset at the end of the term. Now it is given here that it is 20,000. Now onto this 20,000, we need to account for the differentiation in between the salvage value and the ending book value, because there's a tax component which we have not taken into consideration while determining the tax based on this depreciation computation, that is based on the part that we have determined. On this depreciation, we have not considered the salvage value. So I need to consider that extra tax over here as part of my salvage value to determine the salvage cash flow. This is how I have got this 18,500. Now is it fine? Pranjal, I hope my voice was coming fine and it's clear now. किसी को कोई question नहीं? Nobody has a question? Everybody's fine with this? Guys are okay with this? Okay. I'm taking this as a yes, that everybody's fine. Okay, so what I was stating was that considering the time constraint that we have, we will take up a topic which we can finish within half an hour. So let's consider this topic of how do we determine your NPV in case of mutually exclusive projects with unequal lives. Take an example and show it to you what we mean. So there are two methodologies of doing that. One is EAA method. EAA method. Second is replacement. Let's look at EAA method. EAA method is also referred to as equivalent annual annuity method. So basically, this is a method we are using in for comparing projects with unequal lives. If I have to compare mutually exclusive projects with unequal lives, I'm using in this concept of equivalent annual annuity method. So we take in this parameter of WACC, which is 10%. So WACC is same as your opportunity cost of capital. WACC is referred to as weighted average cost of capital. So we will actually also look at how do we compute WACC or how do we determine WACC when we consider the CAPM model, capital asset pricing model. This will be happening next week. We will be looking at CAPM model, capital asset pricing model. Therein, we will do the computation of WACC in detail. Okay. Now, consider a project. You've got year. We've got, let's say, project A. And we have got project. So we look at, let's say, I have two projects. One is of 3-year duration, other is of 6 years. 0, 1. Project A, if I look at minus 70 is the investment, 28 first year cash flow, 33, 38. Project B, minus 85. Minus 85. Sorry. Oh, it's okay. Minus 85 is the investment. And let's say I take in the cash flows as 35, 30, 25, 20, 15, 10. I've taken two projects. Project A, this is the investment and these are the cash flows. Project B, this is the investment and these are the cash flows. Now let me determine the NPV for this. Basically, if I use the normal computation, my NPV would be, my cost of capital is 10%, comma, these are my cash flows, plus in converting this to a number, 11.28 is what I'm getting. Same way, PV 10%. These are the cash flows plus this one. Converting this to a number. So which project is better to undertake this investment, guys? Project A or project B based on the NPV value? Project B. Everyone thinks it's project B. Okay. Let's see whether we are right or not. We will be using this equivalent annual annuity method, wherein we will see how we compare projects with unequal lives. So the formula that is, this formula is first, I'll put it on over here. I'll just copy this formula and type it. So the formula that I have is something I'll mention over here first. Computation of equivalent annual annuity. Let's see how we compute. So R is the rate, 10% over here. NPV is the NPV we have determined, 1 minus 1 plus R to the power minus N. N is the number of times, N is the term of the, so here it is 3 years, here it is 6 years. Now let's determine the EAA and see which project is better. So we have equal to 0.1 multiplied with NPV divided by divided by 1 minus 1 plus 0.1 to the power minus 3. Since this is for 3 years, except this, I'm getting this. Same way, equal to 0.1 multiply this with NPV divided by 1 minus, so there is a mistake I've done or what? No, it's fine. It's 1.1 plus 0.1 or 1.1 to the power minus 6. Yeah, same, right? Correct. So now which project is better based on EAA? Reduce this. So which project is better now? So what we find is project A is better. Basically, when you have got unequal lives, just by simple NPV computation, you cannot decide. You need to use two methods are there. One is EAA method. Second method we'll look later on. EAA method is equivalent annual annuity method. This is the formula, and this is how you determine your equivalent annual annuity. What is the significance and meaning of this 4.53 and 4.37? This is now what we will look at. Okay? Otherwise, it's just a number. If we don't understand the significance, it's just a number for us. So what we are basically doing is we are spreading the NPV over the lifetime of the project, or we are taking the NPV, finding the annuity and spreading the NPV over the lifetime. Let's see what this is, what this signifies, or what this is telling us. So let's say, suppose, go to my computation again. So let's say instead of this, I put in 0, and I'm linking this with this one. Make this constant, function F4 or F4, and just drag it for 3. This one. Secondly, 0 equal to 4.37. Just fix this and drag this across for 6 years. This is what we have done here. Okay. Now, suppose if I compute the NPV now, what will I get? NPV 10% equal to NPV 10%. So basically, I've got same, this is 11.28 and 19.1. So what I have done is I have spreaded this equivalent annuity over the timeline of the project to determine this. This is the significance of this equivalent annual annuity. And this is the method we use. So based on this method, project is better. Any questions, guys? Anybody not clear with the concept here? Any doubts, any questions, guys? Anybody not clear with the concept? Anything you want an explanation on? Understood, everyone? If you have questions, you can ask me. Project A is a good project to invest in. Yeah. Can you explain conceptually? That's what I think I told. I'll explain that again also. No problem. See, basically, if I'm looking at this EAA, what I'm doing is I'm utilizing this for comparing different investment projects having different lifespan. Okay. Basically, what I'm doing is I'm taking the NPV, finding out the annuity, and spreading this annuity over the lifetime of the project. Basically, what I have computed based on the formula is the equivalent annual annuity. This is the annuity I have computed. This annuity is something which I have spread over the lifetime. So if you see, this is for 3 years, I've spread the annuity over here. 4.37 was for 6 years, I've spread it for 6 years, and then I've determined the annuity. This is the theoretical concept behind it. So I have taken the annuity and I have spread this annuity over the lifetime of the project to determine the NPV. So whichever has got a higher equivalent annual annuity is a project worth considering an investment, because based on NPV, we cannot decide, given that the timeline of the projects is different. This is the logic made. Understood? Given a theoretical explanation also behind this. Any other question, guys? Anyone not clear with the concept here? Everybody's fine? Move ahead. Now, we take in second part also. So the second method that I have is the replacement method. That is referred to as replacement method or replacement chain method. Second. So I'm looking at replacement method or replacement chain method. So considering the projects which have got unequal lives, we need to do certain adjustments so that both the projects are going to be evaluated over similar lives. So let's consider this logic and see with the computation. So let's say WAC is given to be, or WAC to be 10%. I'm say taking in the same data that the computation becomes easier. Yeah. Cash flows in the investment that I had. So I have project A, project B. Now I'll show you how do we replicate this sort of column. So this is project A. Now when I'll replicate project A here, okay, project A, what I'm doing is I'll replicate like this. Minus 70, 28, 33. Okay, I have replicated project A. Now, what is the net project A cash flow after replication? Net project cash flows after replication. That would be sum of these two. We just dragged it across. I've got this project cash flows after replication. Okay. Now, once I have determined this, so now if I determine the NPV of this would be NPV 10%, comma, these are the cash flows, plus this is so converting this to a number, 90.75. If I do it for project B, I get is 10%, comma, these are my values, plus in. So project A is better than project B. And if I only do for project A without replication, it doesn't make sense. The values will be, the NPV value will not make sense. But still I'm computing just to show you this, what number we are getting. So we get this as 11 point. So when we have replicated this, this is the NPV value we have found out, which is more than what it is for project B. So that means investing in project A makes much more relevance. So this is referred to as your replication method that we have. Okay. So if you want to use your replication method, you can use this. So this replication method is also known as common life approach method also. Replication method or common life approach method. Okay. So this is for cash flow projections that we are taking in consideration when we are repeating it up to the least common useful life. What that means is, let's say in project A, if this is for 3 years and for project B is for 5 years. So when we have to consider least common multiple, least common life, we will have to do it for 15 years. 3 into 5, 50. 15 years will be the least common life. So this is the principle behind this replacement method which is also referred to as common life approach method. Is everyone clear with the concept of replacement method, with the concept of equivalent annual annuity method? Any questions you have, guys, for me? Any doubts, any questions? Anybody not clear with the concept? So this is, I think, what I had for discussion, because I don't think so we will be able to complete the next bit if I start today. What did I say for 15 years? Okay, I'll repeat. No problem. Basically, what I said was, let's say there is a project A which has a life of 3 years, given lifetime, and project B has a given lifetime of 5 years. Then the least common life of the two projects taken into consideration will be 3 into 550. Let me take another example. Let's say project A has a life of 2 years and project B has a life of 6 years. Then the least common life will be what? 6, 2 into 3, 6. Okay. So another example, let's say project A has a life of 3 years and project B has a life of 4 years. Then least common life would be 3 into 4, 12. So this is how you can determine for how long you need to use this replacement. Actually, it is better to use EAA approach because EAA approach is easier to implement. When your a number of years become too huge, implementation of replacement method becomes very cumbersome. So their EAA method is much more helpful in terms of computation. You may have to replicate project B. So for example, Pooja, the scenario that I have given you, when you have first project A has three years and project B has 5 years, then you need to do for 15 years. So 3 has to be replicated 4 more times and your project B has to be replicated twice. Okay, understood the computation but not the meaning. See, the meaning behind this is that what we are trying to do. So the problem that we faced with NPV was what in the first case? That for unequal lives, NPV as a measure is not making sense. Reason being of unequal lives. Now, when we are using this replacement method or common life approach, what we are doing is we are making the lives of these two entities equal, or the lifespan of these two projects equal, such that when we make the lifespan of these two projects equal, we are able to compare the NPV. This is the logic behind this replacement method usage. I hope it is clear, Pratik, what is the logic and why we are doing this. Anybody not clear with any of the concepts, guys? Any questions you have? Today's session is something we have discussed a lot of concepts, and I am assuming a lot of you are new to this. So if you have to use either of them, I would suggest EAA method. Equivalent annual annuity method is more preferable than the replacement method. Reason being, you have to do a lot of number of times, makes it very confusing. EAA is better. So we have considered, or we have started a lot of new concepts today, which I presume people who are not part of this and not had exposure to this earlier would be new for you guys. So do go through these concepts. Because what we are going to do in the next set of sessions, on the next 4-5 sessions, is we are going to build up more on these concepts. The concepts are going to be tougher. The case studies are going to be there. The mini caselets are going to be there. So, I mean, it would require that understanding of the concepts to do all those things, or to learn more concepts per se. So the idea is to build on those concepts. My advice, guys, would be please go through whatever concepts we have discussed, especially today, because yesterday's class was a repeat class. And if you have any doubts, any questions, please feel free to let me know next Saturday related to whatever we have discussed. We will take that. Right? Any questions, guys? Anybody not clear with any of the concepts? Mac, Power BI. How come Power BI came into this discussion? Mostly we use Windows only in industry. Mac, I don't think so, is compatible with Power BI, but that's not the relevant thing over here. Yes, yesterday's session was repeat of last Saturday. So a lot of people last Sunday told me they were not able to join in last Saturday's session. So that's why we had a repeat yesterday. So Mac is not compatible for Power BI. That's correct, but that's a different discussion. Okay. Anything else, guys? Guys, I can't. I mean, I can a data train team to upload the data. Okay, I'll put in a request, but I am not the person who does that. I can put in a request, but I don't know what the output would be. Okay? Because I only take care of the training part. That's the point. Okay. Okay. Any questions, guys, related to the topic we have discussed? No, no problem, Shantanu. Any questions, guys, related to the concepts we have discussed today, starting from NPV, IRR, then doing a mini caselet, XIRR. Okay, you want the data. Actually, Pooja, whatever computations that I show you are the Excels I have already pre-shared with data train guys. So I have created Excels wherein all the computations are there. But you would have the recordings also, Pooja. So probably you can go and try them. So what you are suggesting is you want them beforehand. That's what you are telling me. You are asking. I'll have to check with the data train guys whether this is feasible or not. Because I am not allowed to share data on my own. Because whatever computations we do, that is pre-shared with them. I'll ask them whether this is allowed. If it is allowed, then let's see whether they allow me or not. I'll have to gain permission from. Okay, guys, thank you for your time and have a great week. And I'll see you next. Thank you, guys. Thanks. Thank you.